One of the things that I always say, like when I'm explaining insurance to somebody, I always talk about term insurance, right? And I say, Kelly, if you and I were going to start an insurance company, we just sell term insurance because, there's not a lot of term policies that pay a death benefit. And that's the only benefit is the death benefit, right? And that the company doesn't think you're going to die. Like if you buy a policy at 35 years old or something, the company has actuarial data that says the chances are really low that you're going to die, but you got to protect your family. So you buy it, right? And then when you're 65, if you wanted to buy a 30-year term policy, the insurance company would laugh at you because they know within that 30 years, your chances of dying are closer to 100% than the 1% or less. So, what I always say is when you buy a term policy, you're betting against the insurance company and they have actuarial data on their side. And I've heard that, if I told you, okay, I'm 55 years old, I grew up and this is where I grew up. There was 1,000 kids in my high school. You could tell me how many of them are dead by now, right? And with some other data, you could get really close to telling me how many of those people are dead, right?
Yeah. I mean, you have a pretty good guess. If you've got a big enough number, that's the key thing you threw out there, the 1,000 lives. So law of large numbers, once you start getting a big enough population and you understand what part of the world they're from, you understand the mortality of that overall group of individuals, you can get a pretty good handle on that for sure.
All right. I think by the time we get this done, Kelly, we're going to take this recording over to underwriting. You're going to upgrade me from select to preferred plus. They say I'm a little bit short for my weight, but I'm just telling you, I if I could just get 6'3", 6'4" on that application, I might sneak in just right under the number for preferred plus. But all right. So let's talk about, one of the questions I get a lot when we look at like a whole life policy. We deal mostly with whole life policies, and I want to touch on kind of how how a whole life policy is kind of manufactured. But people will say to me, well, how does the insurance company guarantee 4% gross? Because they're not getting 4% on their portfolio now. And how do they do that? Can you just touch on that for a minute?
Yeah, and this is a really timely question too, because it fits in really well with the regulation change that we at Emeritus and the entire life insurance industry is dealing with. As end of last year, the 7702 changes just got passed, so there'll be a tie-in there as we move into that part of the discussion. But the 4% guaranteed rate, which it's commonly called that when you look at our whole life policies. If you look at a specimen contract from Emeritus, it's going to say contract rate 4%. And what that means, it's not going to say you look at your guaranteed cash value at year 10 and it's $10,000, and you look at your guaranteed cash value at year 11, it's not automatically going to be 4% higher. That 4% is used in the guaranteed cash value determination, but it's really more of a reserve calculation. So to your point, the gross mortality and the gross interest rate used in determining guaranteed cash values is 4%. So it basically says when you look at the maximum age, let's say age 121 on $1 million policy on a whole life contract, doesn't matter which company you're looking at, they're all going to have the exact same guaranteed cash value at age 121. It's going to be exactly the same as the death benefit. And that's the way those guaranteed cash value calculations work, is from the time you issue that policy to the time they hit age 121, guaranteed cash value is growing and increasing each and every year. But the 4% isn't a true guaranteed internal rate of return. It is going to vary quite a bit year by year. For most contracts, it probably peaks at about 2.5% if you're looking at a guaranteed actual rate of return, because that is going to be net of the death benefit, or net of the mortality costs. And that also doesn't bring into consideration the guaranteed premiums, because you could have the exact same guaranteed cash value on two different contracts, but one of them might have a premium that's 20 or 30% less. So obviously that one's going to have a stronger internal rate of return on the guaranteed cash values because you're paying a lot less premium to buy the exact same guaranteed performance. So,
Right.
so yeah, there's a lot of different moving pieces there.